All right, folks, welcome back to the Property Couch podcast, and we got an exciting episode for you today. Ben and I have been underground looking on the internet to see the most requested questions that people ask. And Ben, we've narrowed it down to the top 5. What do we cover?
Well, Bryce, here's a couple of samples. Are apartments good investments? How do I pay my mortgage off quicker? What about capital gains and serviceability? Ooh, lots of great questions.
They are great questions and more, folks, so stick around. Let's rip into the show.
Welcome to the Property Couch, where each week you get to listen to two of Australia's leading experts. Bryce Holdaway, co-host of Location Australia on Foxtel's Lifestyle Channel, co-host of Escape from the City on the ABC, and partner of Empower Wealth Advisory. Ben Kingsley, chair of Property Investors Council of Australia and the founder of Empower Wealth Advisory, named the 2018 and 2019 Property Advisory Firm of the Year. Stay tuned as they bring you the insider's guide to property, finance and money management.
All right, folks, welcome back to the Property Couch podcast. And of course, Ben, welcome back to you too. How are you, mate?
Mate, I'm well. Another week closer to the footy season, but I'm not going to go there just yet. But let me just say I'm excited. I'm excited by the next AFL season. We'll leave it there.
Well, you should be excited too, mate. But for those of you who didn't get a chance to listen to the episode we had with Kyle Langford a couple of weeks ago, Ben, I'd encourage you to go and check out the YouTube version of that, because right at the very front, there is an epic little piece where Kyle smokes the Collingwood supporter. So it was, I think I watched it 3 or 4 times in a row just to enjoy the moment. So just to see your Collingwood sneaky reference in there and raise you one.
Hey, but I do want to say, if we are talking about previous episodes, last week's episode in terms of the property market outlook and predictions, we've had a tremendous amount of responses for that. So thank you for everyone who's putting in some comments and some feedback back to us, some constructive feedback, some strong views in terms of where they think the property market. That's what we want. We want healthy debate about where the property market's going. So thank you for that. And of course, we can't move on, Bryce, until we thank our incredible team who put together a little celebration for us in terms of our 10-year anniversary. So to Ivis, to Ardit, to Patrick, to Shayna, to Carmen, and all of the team who's been involved in our 10 years, thank you very much. It was very kind of you. And if you want to check that out, you can obviously, we were surprised. We had no idea when they came in as we were about to start that the predictions and outlook episode. So thank you to everyone there. You do a great job.
Did throw us a little, didn't it? But Ben, is it too soon to say we're in our 11th year now?
Well, officially, we're in our 11th year, Bryce, so you can say
that's really milking it, though, isn't it? Like in the shadows of our 10-year celebration, we're in our 11th year. But no, it was wonderful, and we have had nothing but joy bringing this podcast to our community for the last 10 years. Hey, just wanted to remind our community, Ben, that mid to late last year, we launched the TPC Companion. Which is basically AI's going in and looking at all of our books and our materials and our back catalogue, and you can go in there and ask any questions you like. We do have a small disclaimer where it's really good, but it's not perfect. So just be mindful of the fact that there might be a few little hallucinations. But if you go to the TPC website on the homepage, you'll be able to follow the link, and it's actually in WhatsApp, Ben. So you go in there. And lots of people are in WhatsApp these days, so you're interacting with our TPC Companion via WhatsApp. So that's something that I want to encourage our community to take advantage of this year, because we get to see all of the questions and everything behind the scenes, to learn the conversations and the questions that people are asking. It'll help us shape future episodes too, because we can get very, very clear on what people are wanting to. Ben,
click on the description, show description to access our companion.
Exactly. Now, Ben, give us a little, we're just doing a little teaser on the My Knowledge section that's happening in Moorr. Can you tell us about that?
The team are busy working on 3 sort of significant projects in Moorr. The first one is obviously the My Knowledge section. So in the current Knowledge Centre, we've got all this rich information. Well, we're migrating that into the new version of the platform, and we'll eventually migrate all of the great content that we have here and all of our free reports and also our courses, and all that will be coming into the My Knowledge section of Moorr. So our vision has always been about Moorr being the single home to manage your financial affairs, and it's what we call our lifestyle finance app. So from that point of view, that's a big piece. You would have also noticed that we've got next date. So we've got this new feature that we've added in there, which is really powerful in terms of reminder dates, not just for bill reminders, but basically what we're going to be building out in terms of using it for to-dos and all of those sort of bigger conversations around goal setting and all that. So next date reminders is going to be a big feature. And then lastly, in terms of the mobile app, inside the web app, we've got all of this rich insights area, and we're bringing that to mobile as well. So the team are working very, very hard on that. And so we should have a big announcement soon about those releases coming out. So yeah, credit to the team. The other obviously big project we're working on is transactions and bank feeds. And so we'll have more to talk about that probably halfway through this year in terms of where we're at with that project.
Super relevant, Ben, as I'm in the Moorr studio here having a little look at all those changes. But yeah, check it out. So if you haven't already downloaded that, folks, moorr.com.au, go and check that out. We are putting a lot of time, energy and effort in making that the best resource for you. You can get access to that for free, helps you trap more surplus. And once you have that surplus, it helps you put that to work, Ben. Before we move on to the show, I also just wanted to remind folks that you and I have been very busy in this last quarter putting together our third book, How to Retire on $3,000 per Week, the Property Couch's Playbook to Passive Property Investing. This is effectively our life's work, Ben, isn't it? Because we, when we wrote the first book, we put our very best in. When we wrote the second book, we put our very best in. But we've now had a very rare opportunity that not a lot of authors get to do, Ben, and we have been able to do that, where we can go, hey, looking back in the rear vision mirror, what would we have done differently? And we've restructured, redone. So the book is totally different, 95% different. So we're super proud of it. And I just wanted to shout out to anyone who wants to get on a waiting list. If you go to thepropertycouch.com.au/playbook-waitlist, link will be on the screen here.
Link in the show description. Yep.
In the show notes. The reason I want you to go there, Ben, is because the first people who are going to get their hand on this book is the people that are coming to celebrate my 50th in Indonesia. I'll talk a bit more about that secondly. So the first people get their hands on it. Second people who get their hands on it is the people who will be on this list. And not only will they be first to know, first to get their hands on it, but also we're going to give them a discount. And then all of the bonuses that we put together, Ben, for the book, which includes a course and the case studies unpacked and audio book and all that sort of stuff. Anyone who's on this list and buys from this list, we're going to make, and I'm talking hundreds of dollars worth of
100%.
Of retail value and thousands of dollars worth of actual value. If you go to that list and you buy from that list when we make that available, that'll be all yours for free as well. So if you go to thepropertycouch.com.au/playbook-waitlist, leave your details there and we will make sure that you get your hands on that with all of those goodies. So, Ben, let's rip into today's show. My Mindset Minute theme is a little tease to what I just said then. I came across this quote: time is the only currency you spend without knowing your balance.
Very wise statement.
Use it wisely. So, as you know, I'm turning 50 this year, Ben. So I just wanted to shout out and say a very special thank you to the people who are helping me use my time wisely. And so that we can actually use this event to do some really good for a lot of good people. So there's no more seats available on that, Ben. That is now fully taken up. So you and I are doing the charity event. Then there'll be the property mastermind that we're all doing together, which we're super stoked about. But there is also an opportunity to donate. So what I'm just saying to folks is very shortly, we're going to send out a link to anyone who wants to get around my 50th. And the way you do that, Ben, is if I personally, you as well, but it's my birthday, obviously. So if I've personally added any value to you over the journey of the podcast over the last 10 years, I'm asking for a favor. I haven't asked for anything in return, but if you've had some value, Ben, I'd love for you to donate via that link. $50 for one eye and $95 for 2 eyes. So, and it can be as little as $1, but clearly I'm asking people to say, hey, listen, donate to this link. It is a wonderful cause. We will be able to capture everything that's going on and be able to share that with our community. So that link will come in the next couple of weeks, Ben. So I'm just doing a little teaser now to say that if that's you, I would love for you to be a part of what we're doing there. All right, let's get on with it, Ben. Today's show is our team have been doing a little bit of research, Ben, and they've come up, they've gone out and seen what are the top 5 questions on the internet, top 5 property questions on the internet. And they've gone and curated those, which is clearly what is top of mind, front of mind to a lot of people who they are just starting out in property investment, and these are the things that they want to know. So we've gone and collated those. We're going to get through those today, and our mission is to make sure that we are as thorough as we can be, with a very strong caveat from the STIG, to make sure that we don't blow these questions out, Ben. So that's the challenge. If you are willing to accept it, are you willing to accept the challenge?
I will accept the challenge to try and stay under an hour.
I like you said try, because it's very unlikely that we will stay under an hour, but here we go. First question this is of the top 5 property questions on the internet. The first question is, are apartments a good investment? Good question, Ben. Are apartments a good investment? Where do you want to kick it off?
Well, I thought we'd kick it off by just looking at the performance of unit and apartment markets over the long term. Broadly speaking, up until around the last 10 or so years, outside of Sydney, the apartment market was actually performing relative in terms of long-term capital growth performance compared to, say, a house and freestanding market. Now, we have seen a divergence in terms of what's happening in the last 10 to 15 years. Again, Sydney being a bit of an exception, but there is still a divergence in that. And that's got everything to do with the land value story, and people now understanding that, what underpins the value of property is the land value as part of that story. So I think how I would try to set this up, Bryce, is that there are different types of apartment markets. So when I think about the different types of apartment markets, I think about the small developments, I think about the medium density developments, and I think about the large developments. And I would normally petition the medium and high density into a higher risk category of capital growth because of the supply risk. So what I always say to people is supply is the enemy of capital growth, right? So if supply is the enemy of capital growth and apartments can be supplied up into the sky, you want to be careful in terms of which type of apartment that you're investing in. But as you and I know, in our 11th year, and as part of our earlier sort of episodes, we were quite comfortable in being 1/6 of an apartment owner on, say, 900 or 1,000 square metres of land, if we're sort of buying in an Art Deco or in a really nice location. And I think that's got a lot to do with, sort of the performance of property over the medium to longer term as well.
I think there's some good points you raised there, Ben, and I also think that it's a generational change thing. Why apartments aren't as high performing as houses, because there's some scarcity in the land, and the fact that in Australia we value lifestyle and we value being able to spread out, which in some European and some Asian and some American cities, they're just used to being on top of each other, right? So number one, as a culture, we're used to spreading out. Number two, if you grew up in the 50s, 60s, or 70s like we did, Ben, the standard Australian dream, the great Australian dream, was a quarter-acre block, a detached house on a quarter-acre block, surrounded by a garden with a hills hoist and a barbecue, right? That was normal. You'd see it on A Country Practice. You'd see it on Sons and Daughters. You'd see, like, all of those shows that we saw back then. All those. What's the Sullivans?
Yeah.
That's the norm, right? But then you think about some generations when we were growing up in the noughties, Ben, they were growing up seeing Friends and How I Met Your Mother and Seinfeld, and it was all apartment living. So it really all comes down to norm. But I think at this point in time in Australia, I think the apartment market will definitely mature over time.
Yep.
But as we currently stand, the crux of the question, are apartments a good investment, Purely as an investor, based on historical returns, our answer is wherever possible, invest in an established house, right? Lots of things that are caveats. Got to have the budget, got to be able to get into the entry price, all that sort of stuff. But as a general rule, wherever possible, an established house. If not a house, then explore the next size down, which would be a townhouse, right? Ideally, to your point earlier about the least density as possible, one of 2 townhouses is better than one of 40 townhouses for obvious reasons, or a villa unit. But then if budget or circumstances or whatever don't allow you to do the house or the townhouse or the villa, the next thing is with an apartment, you'd want to do it in prime areas. So if you think about blue chip suburbs along the river in Brisbane, in the inner suburbs of Sydney, inner southeast of Melbourne, like in those prime suburbs, prime areas, if you can make sure it's got scarcity, which you touched on before with the deco, or the minimum amount of possible, or you've got a view that doesn't look into other people, make it feel like a fishbowl, or you're on the ground floor with a courtyard, something like that. Because then what it does is it ups the owner-occupier appeal, because the enemy of apartments is when you feel like it's vanilla. Same, more of, heaps of, right? So scarcity, owner-occupier appeal, and then some form of investment worthiness. And what that means is don't go and buy off the plan. Don't go and buy something that has zero track record, zero history, an architect who's under pressure to be profitable, gets into their computer late at night, pushes a button that says reduce everything by 15%. Everything gets small. You don't want that. You want to have some form of track record. So if it's an apartment and you're in a prime area and you've exhausted all your opportunities to get a larger land area, that's one. And then if you're in an entry-level area, and we've talked a bit about this in our new book, not a lot on the podcast, Ben, but in the new book, which is another reason why you should get on our waitlist, Ben. But in an entry-level area, you'd want to go against buying a single apartment. But in some circumstances, a lot of people have created a lot of wealth by being able to acquire the whole block. Think 1 of 4, 1 of 6, where they were able to control the block, control the yield that came as part of that. And it was a yield play as well as a small apartment play as well. So, Ben, if we go back to the crux of the question, are apartments a good investment? My answer is maybe, but I think once you've exhausted all other options first.
Yeah, I think so. And I think to your point, proven resale value, exclusivity is a big one. So when we've done the analysis on apartments that are absolute waterfront or have views of, say, the Opera House or the harbour bridge, those types of things, we can even see them up at sort of 18, 21 stories where they've got those views. They do sell well, and there is some, exclusivity and status associated with those harbour views. But if you're looking out over suburbia on the 18th floor compared to the other side looking out over the harbour, there is a material price difference between those. So what is that telling you? That is telling you that people will pay a premium for that emotional or that exclusivity. So where you see a great premiums paid is where you absolutely can't be built out and the view that you have is quite unique. Okay, so even if you have a coastline and you fill, say, the Gold Coast up and you have that whole Broadbeach coastline, and so there's literally thousands upon thousands of apartments that all have that ocean view, they will still get a better price than being 3 streets back or looking over you still don't have that exclusive scarcity. You still have good scarcity. And so they're the types of things you want to be thinking about when you're looking at these in terms of what's my resale value. And we've always talked, years ago, we talked about the funny stories that on the 17th floor, the 18th floor was $10,000 more. The 19th floor was another $10,000. Like, there's no real value in that in terms of that pricing structure. I think what I see at the 17th floor compared to what I see at the 19th floor, if I can never be built out, is not necessarily a thing. So if I'm thinking about getting rental yields and all that, anything where I know that I can't be overgrown through palm trees or any other sort of thing that can obstruct my absolute waterfront view, I wouldn't be paying a premium for the higher levels. I'd actually be paying a good dollar for the lower levels because obviously I can get down the lifts quicker. I can be more productive in terms of if I'm living there, or from a rental point of view, I'm going to get a higher rental yield as opposed to being up on those really high floors.
Yeah, so well said. So a couple of things: advantages of an apartment: low entry point, attractive rental yields. You can be in prime urban locations.
Yep.
The maintenance responsibilities are reduced, and there's more predictable expenses.
Yep.
There's some lifestyle appeal that you can get. So a pool, a gym, concierge, lifts. They're all advantages if once you're living in there. But I'll talk about the disadvantages to that in a second. No or lower land tax, and you've talked to that exclusivity piece pretty well. So the disadvantages are the lower land to asset ratio, the risk of oversupply. Strata fees can include all those wonderful lifestyle appeal things, which really blow them out. Limited customization. In some cases, you only have to sort of Google some apartments in Sydney, for example, and they've had some real building quality issues.
Yeah.
We've talked about the comparison to houses is lower, and you've got limited control and decision making, and also a bit of a reputation of the strata. So I think as a cross section to this question here, are apartments a good investment? I would say to you that houses are better.
Houses are better, and it depends.
Yes.
And that's where the art form of the selection criteria is everything we just talked about.
Yes. Yeah. So good question. Top 5 question on the internet, Ben. That's one of them. We cover that off. The next one is investment property versus shares. Which one is better? Ben, which one's better?
Well, yes, let me set this up. I think I've been on record many a time to be talking about this. As a young man in my sort of late teens and early 20s, I was avidly looking for pathways to wealth creation. I bought many a share, some speculative, some blue chip, and I had mixed results, as you would expect. I really, I was an enthusiastic amateur, is what you would call me, in that sort of time. Some of the shares I bought, CSL, at listing, if I kept them, would have been worth a fortune now. And others, like BMC Media, I think is one that I lost several, thousands of dollars on, which was an internet stock back in the internet bubble, the early 2000s. So that went up and then crashed down. So I think I broadly speak about this in terms of how did I find my way to property? I found my way to property because as an investor, that volatility, that uncertainty, that lack of control took me on a direction that I wanted to be in more control of my investing. And then when I found the magic of leverage, being able to control that value with a low output of cost really cemented my view that property is an essential need. We have to live somewhere. So if I continue to keep studying the human behaviors, economics and so forth, and understanding the value of land, that's how I built out my knowledge over time. And then I've gone through into being a more avid property investor that I am share investor. But as you know, Bryce, I have shares in the US, I have shares in Australia. So I still invest in those particular markets. So that's the sort of way in which I would summarize my own investment journey. And so for others who are thinking about this pathway, there are definitely things you need to consider, such as what is your risk profile? How do you feel if the share market or the business that you invested in is going to drop by 20, 30, 40% in a very short period of time if there's a serious correction in the market? So it's those versus property hasn't necessarily had that volatility, but we do know those numbers can happen in high-rise apartments. It can happen in, lifestyle locations where they're, or small one industrial towns. You can get these boom and bust cycles also in the property market. So you can't just do a general view that property is better than shares or shares are better than property. It is a case-by-case story.
I think you raised a really good point, Ben, because people would be surprised to know that you and I do have both, right? So it's not like we've exclusively said property, but it's definitely true that property is our primary investment vehicle, and it's largely around leverage, right? So I want to know what other experienced commentators say about this, Ben. So if you go all the way back to episode 200, we had Paul Clitheroe on, who's a highly respected financial commentator and the former host of Channel 9's Money Show. When we asked him that question, he was emphatic. I don't care. You remember how many exclamation marks he said after? I don't care. If you have shares, get a property. If you have property, get some shares. So the key takeaway from that part of the narrative was, well, diversification matters. So that's great. It's good to have some balanced, pragmatic views there. But I think the leverage is the important part here. So what I want to try and do is paint a picture largely for an audio audience. But imagine you've got investment 1 and investment 2. Now, investment 1 is offering 8% growth, 4% yield, total 12%. And investment 2 is offering 6% growth, 4% yield, so total return is 10%. Which one's better? Now, if that's all the information you've got, clearly I'd prefer the large overall return, okay? But let's expand that out a little bit more. Let's say for investment 1, you've got $100,000, and for investment 2, you've got $100,000. Investment 1 does not have any leverage at all, okay? So your $100,000 in cash can buy $100,000 of investment 1. But investment 2 allows you to get some leverage. So let's say that you can actually get 80% leverage on it. So your $100,000 means you can control a $500,000 asset with $400,000 worth of debt. Now let's have a look at the returns over time. Your return on the investment 1, you remember, was the superior return at 12%, Ben. So 12% of 100,000 means you get 12,000 bucks. Now, investment 2 was the inferior return, but you've got a larger asset. So 500,000 getting 10% return gives you 50,000. So what we got here is a comparison of a 50,000 return versus a $12,000 return. But that's not all the story, because with leverage, there's a cost to get the leverage. So in this case, you've got $28,000 in interest for that. So your 50,000 minus your 28,000 leaves you with $22,000 net return. And that's what we got to compare, because we've got 22,000 on investment 2, we've got 12,000 on investment 1. So overall, you're getting a 22% return on your invested 100,000 versus 12% on your invested 100,000. And that is the overall thesis, folks, on why Ben and I are in property in the first place. That is the independent umpire for us. We don't care which one's better, because all we care about is getting to our goal on time. That's it. We just want to get to our goal on time, Ben. So therefore, leverage becomes the independent umpire.
So Bryce, I think you explained that really, really well from an audio point of view. But if obviously you're watching along on the video, you can see the chart in front of you. That's that cash on cash return where we're basically bringing home that. And if you think about expanding that over the decades, what's also then happening is you retire that debt out and you live off the passive income, which is obviously what we're trying to achieve here in terms of that story. But it also reminds me in terms of that volatility piece that we were talking earlier about. Margin calls occur in the stock market. And in some cases, even though you're investing in really good businesses, it doesn't matter about the quality of the business if the market's melting down. Usually you're going to be caught up in that particular event. And that ultimately can be risky because it means that they will liquidate some of those shares. So that locks in some of those losses. And I think that's a really important thing about where you feel comfortable, about how much control you have versus the control you don't have. Now, I will say, and I'm on record of saying this many, many times, some of the businesses that you invest in through the share market, those businesses can turn into the next Amazon, the next Google, the next NVIDIA, and they can be financially transformational in terms of the wealth that they can create. Can be so much bigger, and the returns can be so much greater than what you'll get out of a safe and secure way to invest in residential property. So there's always going to be those exceptions to that. So remember, if you are investing in shares, you are investing in the business. If you're investing in ETFs, exchange traded funds, you're investing in a group of businesses. And so that gives you some of that diversification protection. In property, the same is true. You're picking one asset in one location, and you will really are relying on the investment and the exclusive nature and the land value that is going to be influenced by those other properties associated around that land. And I think that sort of brings the story around. It's ultimately up to you. How comfortable you feel about bricks and mortar tangible investing versus digital investing in terms of share certificates and picking winners when it comes to one business competing against another in a particular industry, and how long those businesses will be able to sustain their competitive advantage in terms of the service or the proposition that they're bringing to market.
Well said, Ben. So there you go. I think it goes back to Paul Clitheroe's statement again, Ben. If you've got shares, get property. If you've got property, get shares. There's a few exceptions there, but clearly for us, we've chosen property purely from leverage. So that's that one, Ben. Next question is, of the top questions on the internet, Ben, is how do you pay off your mortgage quickly?
I've got a tip. Are you ready?
Yeah.
Spend a lot less than you earn and put that money into an offset account if you have one. If you don't have an offset account and you've got a basic mortgage, then make sure you make regular automated repayments that could be as often as every week, or even more often if that's even crazy they want to do. If you don't get any charges for the number of repayments that you're making into the mortgage, that's one entryway in terms of, because remember, interest is calculated daily and applied on a monthly basis. But if you have
That's the key crux, Ben. What you just said then is the key crux that we want everyone listening to this to know is interest is calculated daily. Once you let that land, everything else makes sense, because that's why you went from a monthly repayment to a fortnightly repayment. Why was that, folks? Because at half time in the month, you actually got the balance being half of your monthly payment on the loan. So therefore, the interest calculated daily was on a lower amount. So therefore, if you pay it weekly, if you pay it daily, obviously, the more you can optimize and maximize that calculation that's being done from the bank at the end of every single day to be on the lowest amount possible, that's how you do it. So first of all, the basics, Ben, you have a budget and you actually go to what our grandparents used to drum into our parents, and we're trying to drum into our own kids, is first of all, spend less than you earn. And some people would have fallen off their chair to hear that, Ben, but it's actually a one-on-one principle to spend less than you earn. Credit card money is not your money. Buying stuff on credit's not your money. Spend less than you earn. Then obviously make the frequency of your payment as often as you can. And if you can make extra repayments, that's great. If you've got overtime, put it onto your loan. If you've got a part-time job, stack that onto your loan. If you get a bonus, stack it onto your loan. If you get a tax refund, stack it onto your loan. If you get a gift, stack it onto your loan. All these things help, Ben, on that fundamental concept of calculated daily, paid monthly.
Yeah, and I think I've told this story before, but I do like the story. I remember when I was focused on paying down debt on one of my properties, one of the first properties I bought, and I went and talked to a financial planner, and I said, I can also release X number, $100,000 in line of credit on this particular property. What if I put that line of credit in the markets? What if because the cost of that money was only 6%, and I could potentially get, I was looking at sort of investment returns of 8.99%. So I can make a margin of 2.99%. So I'm thinking I'll go after that. And Mark McGrath, who was the financial planner at the time who I spoke to, he basically said, Ben, and what happens if the share market corrects? Or what happens if that term deposit, that investment that's in property collapses? What happens to your $100,000 then? Oh, good question. So is that money guaranteed that you're going to get the 8.99? No. He goes, well, there's your answer. So play it safe was his advice. And I think that's sage advice, because I'm now obviously 30 years beyond that time frame. And I'm hearing, on social media and finfluencers and all of these sort of so-called young experts who are well, maybe you can get an ETF margin loan facility and you can do this and you can just fast track it in terms of that. And we've got property spruikers, and we're going to do a whole episode on this, Bryce, but you've got property spruikers who are saying, well, why don't you buy, 2 or 3 off the plan or house and land packages that are positively cash flow, and so then lump that into your mortgage and pay that off? Or what about, the tax schemes around interest, interest on interest? So you let your investment property loan spike up and you get, it's tax deductible, but all the rent goes into paying it into your home loan. So there's all of these schemes and ideas around how to do it quicker. The reality is they all carry risk. and they aren't all necessarily guaranteed to deliver you what you want. So what Bryce and I have just been talking about fundamentally is put as much money as you can earn into your mortgage as quick as you possibly can, or into your offset. We've talked about this before as well. You can listen to other episodes. If this property is going to be turned into an investment property, we don't want you to pay the loan down. We want you to build up the offset bucket. Okay, so that is our first preference, is paying it into there. Our second preference is that if you do have available equity and you do have a long-term wealth creation story, then property investment and accumulating a couple of sensible investments, but don't be seduced by these house and land package, or be seduced by these massive tax deductions in terms of what you're going to get, because you are going to be led astray, because those properties do not perform at the level of what existing freestanding classic land to asset ratio properties do. So that is really important in terms of how you do that. And if you also get invited to some exclusive masterclass where they're going to unpack the lock secrets. Here are the secrets, people. You don't need 2 days to learn this. Spend less than you earn. Put all of your money into your offset account. They're going to teach you to sell all of your assets. And so then you lob all that spare money that you've just on in selling your golf clubs, or selling your watch, or selling the clothes in your dresser or cupboard that you don't use, and then put all that money in. I mean, these are just common sense budgeting things in terms of what you potentially do. If you've got a motorbike sitting there that you're not using, sell it. Well, that's also logical in terms of that. Get yourself a side hustle. That's also potentially logical. And you don't need a 2-day masterclass or to pay $8,000 to someone to tell you this. This is ridiculous. It's just common sense. It's in both of our books. It's called Money Smarts. It's on the Moorr platform that you can use for free. So please, people, when you get seduced by these social media ads about paying off a mortgage quicker, we've just given you those clues in terms of that's what you need to do. And don't get aggressive in terms of these investment theses that these young people have in terms of getting ahead. They can potentially backfire on you. So if you're going to do something like that, go and speak to a financial planner and get professional expert advice. And those people who care about protecting your money first before basically you then spending your money to make more money.
Well said, Ben. So let's summarise. The basics are: make sure you have a budget so you spend less than you earn. You can pay as frequent as you possibly can, and you make extra repayments by pooling in extra funds that come into your world. They're the basics. The advanced, Ben talked to it, is use offset accounts. If you don't understand the power of an offset account, you are doing yourself a disservice when it comes to paying off your mortgage quickly. It is a transaction account that you can store money that is offsetting the interest that you are paying, which then goes back to our number one premise, Ben, which is if you can get the calculation being done at the bank to be on a lower amount daily, then you will pay more principal and less interest from your repayment. You can also refinance to a better loan structure, lower rates, reduced fees, and you can also reduce the loan term. 30 years doesn't have to be 30 years. If you've got the capacity to actually make that loan term shorter, that's how you can pay it off quickly. Now, there is an opportunity cost, Ben. So the bigger picture is we all want to pay off our mortgage as quickly as possible. There is an opportunity cost because all of the funds that you are redirecting to pay off, you may want to consider, you touched on it earlier about arbitrage opportunities, but you may want to invest in extra money in your super. Or you may want to buy an investment property, or you may want to buy some shares, or you may be part of the millennials who want to buy some crypto, whatever. So that becomes an opportunity cost conversation where you go, do I have a gazelle-like focus on paying off my mortgage? That's one strategy. Or do I have an optimized strategy on paying off my mortgage whilst taking some of the funds and redirecting it over here? But I think the important point here, and I'll summarise what you said, beware of spruikers in this space. We are going to do an updated episode on this, but churning loans for no benefit, charging you money for stuff that isn't necessarily not available publicly. And here's the deal, folks. Take it from 250. Well, I'm almost 50, Ben. Take it from guys we've had a few laps around the sun, and we've been part of the energy of, hey, I've got a new secret that no one's ever heard of. Guess what? there are no new secrets that no one's ever heard of. All it is people who have got the wisdom passing it on to people who don't have the wisdom, because I can promise you our forefathers already knew this stuff, and it makes its way into, like we said, money smart. So there's nothing over and above what already exists in the marketplace. So the question is how to pay for your mortgage quickly. Hopefully we've tackled that one. Next question, Ben, question 4 is, what do you need to know about property and capital gains tax? Ben, why is this even important?
Well, it's important in the sense that there's an unfair marketplace when it comes to residential property. So if I've got a principal place of residence, so I'm allowed to nominate one principal place of residence in which I own, and if I do that, then any capital gain that I have on that property, I don't have to pay any tax on. Okay, so the market favours owner-occupiers in terms of future gains that they're going to make on that particular property. However, for investors, as is with shares, if I experience a gain and I've held that property for 12 months or more, then ultimately I have a 50% concession or discount off the gain that I've occurred. And that is then forming part of the income that I've earned in that year, but I get to adjust that 50% off. So the reality is when you're thinking about investing, you're thinking about how long I'm going to hold that asset for. Am I trading or am I investing for the long term? If I'm investing for the long term, I get that concession. That concession was introduced by the Howard government to basically adjust for indexation or inflation, i.e. the cost of future money is worth less. And so ultimately, you shouldn't have to pay a gain on receiving a material value that's less than what it would be in present value terms context. So that just gives you a bit of an idea in terms of that capital gain story. But there are some sort of understanding and principles and rules around that, around what forms part of the capital gain and what are those costs, aren't there, Bryce?
Ben, there is, and I'm old enough to remember, Ben, I used to have to work out the indexation on the cost base. There was, in the Tax Act, we did that before the 50% concession came in. Now, folks, just a little sub note on that. That's if you hold it in your own name. If you hold it in
Correct.
another structure, that will largely not be the case. But what is the capital gains tax? Is simple. It's calculated on the profit made from, in this case, we're talking about property. So when you sell a property, if you make a profit, you need to pay a capital gains tax on that. Now, it applies only to the gain, not the entire price. So if you bought it for $250, you sell it for $500, you don't pay capital gains tax on the $500, you actually pay capital gains tax on the profit between $250, any adjustments, and the sale price of $500,000. Now, what are some of the things you need to consider with that adjusted cost base? Well, it's complex and there's many facets. But first of all, there's the purchase price. Then there's the purchase-related adjustments. So think, okay, the stamp duty that I paid, any legal fees, any inspection fees, that gets added on top of the cost base. And then, of course, if you do any capital improvements with renovation and landscaping, for example. And then when you sell, there's also adjustment costs, because you had to sell usually 99 times out of 100, Ben, with a real estate agent involved. So you've got to pay them a fee. Then you have to pay a conveyancer to draw up the contract and get everything sorted. So if you bought it for $250 and you sell it for $500, quite often the capital gain is not $250. It's actually less because of all the adjustments that need to be made. But what happens when you work out the capital gains tax, Ben? Well, ideally you would do this before you sell, because then you can go, what are my pre-tax returns? In that case, $250,000. What are my post-tax returns? Because once you've adjusted the cost base and then worked out what your profit is, and then take away the capital gains tax, that's when you actually know, should I actually sell? Or in some cases, Ben, it's better to just go to the bank and leverage against your gain, not sell the goose that lays the golden egg, and then go into the market and buy again. But there's some things you can do to mitigate, Ben.
There is, and I think about this in the sense of that planning point. So, Bryce, remember that the gain that I make is income added to that tax year. So the tax planning piece is actually important. So if my wife and I own 50-50 in an investment property, and we've had it for a long period of time, or whatever that may look like, but we are definitely committed to building our forever home, and so we need to sell that property, ideally not, but if we did, and that's the case, well, my wife just might happen to be on maternity leave. And so while she's on maternity leave for that year, she may be earning very, very little in terms of, so that might be a good year in which she would then get her tax added, because her tax rate might only be 30 cents in the dollar instead of 37 cents in the dollar, or even in some cases the high extreme tax rate of 47.5 plus Medicare levies and all of those other things. So we rounded up to about 47%. So from that point of view, that's why that tax planning, to your point, is pre-tax and post-tax is really important. So this is what we're sort of saying. Now, again, if you're speculating, if you're flipping properties and all of that, these mitigation risks is what you got to think about. So that 12 months in terms of holding that asset from the 1st of May to to basically the 1st of May the following year, that's the 12-month period that you need to hold that asset. In terms of what I just talked about, that's selling in the lower income year, and thinking strategically about that. If you've also owned an asset and you've experienced a loss, I've definitely still got to this day some shares that I have bought that I have had losses, so I get those carried forward losses. And any future share gain that I make, I know that I can also carry forward or realise that loss in the future gain that I've made if I sell some other shares in the future as well. So it really is important, again, to do tax planning around this and understand those types of things. I mean, especially for property, if you're thinking about subdivisions, if you're thinking about all those types of things, record keeping and other important documentation as part of that is essential. And that's why, again, if I'm giving a little plug to Moorr, we want to make sure that you can record all of that information in there, and we are building it out so it becomes the best bookkeeping environment for all your investment properties, where you can track all of that history and you can store all that documentation.
And just a little reminder that capital losses and capital gains can be offset against each other, but they usually get quarantined. You can't offset a loss with an income gain, for example. But again,
Yes,
to Ben's point, seek professional advice. So a couple of tips: go online, check out the calculators. Definitely consult with here's the little tip for us: a property investing specialist tax advisor would be wonderful. Someone who is in the game, loves that lane, because there's a ton of tax act that they've got to be across. So why not get someone who's really in that lane? And to Ben's point in Moorr, document all the expenses thoroughly. So what do you need to know about investment property and capital gains tax? Hopefully that has covered the basics for you, and something that you do take seriously. Do not take that lightly at all. All right, Ben, as we go to question 5, how do lenders calculate serviceability? And let's kick it off by saying, what do we even mean by serviceability?
It's a great question. So what we're talking about here is a lender is going to have a look at your financial situation in a snapshot. So they're taking a moment. So you're going to apply for a loan and you're going to disclose to them your income, your expenses and assets and liabilities at that particular time, and those commitments. And that lender, and every lender is different, is going to apply different risk mechanisms to work out how much they think you should be able to borrow and ultimately repay their money, right? They're in the business of lending money. They're in the business of taking calculated risks to lend you their money. And then ultimately that's where they get a return on lending that money to you. So that's the essence of sort of what's going on here. So when we then break that down, what we do is each lender has an individual calculator. And so we can put all of that data into their calculators, and we can basically see in some cases that calculator will spit out the maximum borrowing capacity. In terms of other calculators, what they'll do is you'll put the borrowing capacity in, and if you have $1 surplus in regards to the amount that you've loaded into those spreadsheets, you'll basically get a pass. And that ultimately means that the lender will consider that as part of, the way in which you would service that loan. And, in terms of what I was saying about these weightings and the way in which they look at it, some lenders will take in negative gearing benefits as an add back. Some lenders will use 70 or 80% of rental income. Other lenders will only use 60% of rental income as part of your assessable income. And then you've got lenders who will use certain types of household costs. So we've got the HEM, which looks after, basically a typical 2-family household with one child. there's a cost of living that is the minimum that they'll use as an assessment, and then ultimately the broker or the banker's responsibility is to look at this and say, based on your lifestyle, if this is responsible to be able to put this application forward to a lender. Now, remember, brokers have a responsible lending obligation. Unfortunately, the banks don't have that. But it's another great reason why you should go to a broker, because at the end of the day, they are liable in terms of the responsible lending that they think you should do. So they should be making thorough investigations into whether this lending is appropriate for you or not.
Now, folks, there are two primary agendas for serviceability. One is first and foremost, it ensures that you won't struggle with the repayments, right? Mm-hmm. So you're taking on additional repayments. So I want to make sure that you can comfortably manage that even if conditions were. So that's number one. That's one lane. But the other one is the banks want to reduce their risk, Ben. They don't want to be lending out money where they're in the business of lending money, but they're also in the business of receiving repayments on time without having to chase them, right? So they're the two primary agendas that serviceability serves. So why does it even matter? Well, number one, you need it to get loan approval. It's one of the key metrics that they use. Two, it'll dictate the loan terms that you get. So the better your serviceability means you get more favourable loan conditions. Think lower interest rates, think higher borrowing capacity, all is dictated by your serviceability, which is why more income is the greatest weapon that you have to get more serviceability, because the bank will largely feel comfortable lending you more money. Serviceability also provides you with that first lane that I talked about, that financial security. So you're not overextended. You can maintain your current lifestyle. That's something that is super important. If you take on more lending, you want to make sure that your current lifestyle is not going backwards, or it's not going backwards without a lot of practical and strategic thought. And then just headwinds, COVID, interest rates rising, GFCs, inflation, changing in governments, all those sorts of things. They want to make sure that is fine. So, but I think, Ben, I'd love for you to talk to this point because you've been quite vocal in the past. But there's a buffer rate that gets applied when serviceability is calculated.
Yeah. So ultimately, the banks are in the business of lending money, right? And they take calculated risks associated with that. But banks are usually profit businesses. They obviously want to return profits to their shareholders. Now, we do have some mutual banks which basically work on behalf of their members, and the profits are re-injected into the services that they provide for their lenders. But the reality is that APRA, which is the Australian Prudential Regulatory Authority, tries to ensure that the financial stability of the lending system is strong. We just saw in the GFC in America, and obviously the contagion that took shape in Ireland and most of Europe, where if those lending conditions lapse, then ultimately you have a situation where that would undermine the reliability of the lending system, which then collapses the economy, right? So at the end of the day, basically money rules the world. So APRA, as the custodians of this, put in lender buffers. So it means that based on the serviceability calculators, they make sure that the lender has a minimum level of buffer that they can repay. So in other words, if interest rates go higher, then ultimately that borrower can still comfortably afford those if those rates went higher. Now, there's obviously a lot of great debate about just how high those settings should be. So when you're coming to the top of an interest rate cycle, the argument should be that maybe that's worth reducing that buffer because it's unlikely now that we'll see rates go higher than that, because when you take money out of the economy, it slows the economy right down. And so there's an unrealistic expectation that rates will get that high. And then obviously as rates are coming down, you'd like to think, well, why do I need such a high buffer? Because the likelihood of rates going back up there anytime soon is lower. But that's the argument in terms of that. So that's what a buffer is. In some respects, we call it the floor rate, and then we put a margin on top of that to make sure that it's responsible for you. If rates go up, you can still afford to make those repayments. The other important thing to understand here is, in terms of how do you improve your serviceability, Bryce is talking about higher incomes coming in. That definitely helps with borrowing power. But the other way to do it is obviously looking at your expenses. Now, even if given that we have a minimum level of household expenditure based on the HEM, effectively that means that even if you are living on rice and crackers, there is a minimum level that the bank will assess you on or the lender will assess you on. So it may not necessarily be advantageous to be basically thinking about your day-to-day spending and getting that down. But where you do get penalised is in credit card limits, because the bank assesses that if you've got a $25,000 limit, you could spend that tomorrow, and ultimately I'm going to then assess that loan is fully realised, and then ultimately the 3% rate that I would then charge will reduce basically your borrowing power that way. And the other one is obviously personal loans, car loans, leases. Those types of things are also judged, and they really do bring down your borrowing capacity. And there's a good reason for that. Bryce mentioned earlier about, when we're talking about how to pay off your loan sooner. The smaller the term, the higher those repayments, because there's a lot more principal built into that as that loan amortizes. So the reality is you usually take out these car loans in 5-year increments. So that's a really high repayment, like $1,000, $1,200. Well, we need to add that into your application, which significantly reduces your borrowing power, and that which is ultimately, does it pass this serviceability assessment? And usually that's a fail. And then so we move the amount that you borrow down until that becomes a pass. So that's how basically serviceability leads into borrowing power.
A couple of other things to think about too, Ben, is to increase your credit worthiness or improving your credit profile. So make sure you pay your bills on time. They can check into that and avoid taking on unnecessary debt. And of course, wherever possible, refinance to a lower rate, to a loan term change that improves. And a lot of the time, Ben, even within our own business, we've got a mission to help people save interest that they're paying. So part of that is refinancing, looking for a better loan structure that ultimately serves the best interest of the client, so that they're paying less. And ultimately, if they're doing that, they're improving their serviceability.
And Bryce, so just as we're closing out this point, this is why, again, using a mortgage broker, and if you're thinking about investment, an investment savvy broker, because you can see differences of over $100,000 from different lenders in their willingness to lend to you. Now, so you don't want to be penalised by your current lender if they're really conservative. Because what we talk about in terms of controlling a higher value of property, if you can really afford that, then it's best to be thinking about that as well.
There you go, folks. The top 5 property questions on the internet. Ben, we almost hit the hour mark, but as we close out today's episode, my life hack today is, it's self-indulgent, Ben, but it's for the fellow sufferers of celiac and gluten intolerance. I was recently overseas, and there's an app called Find Me GF. And GF doesn't stand for good food, Ben. GF stands for gluten-free. Find Me GF app, and it takes into the technology of where you're standing, and it's a crowdsourced app that you can get other people. So I've been to this restaurant. The gluten-free options were pretty good. Check it out. And it saved my wife and my life while we were over there, because when you're trying to find a meal in a hurry, particularly when we're over on a conference and we got a small break for lunch, Ben,
Yes.
it allow us to find something without getting into line to realise there's no gluten-free options. So for my fellow gluten, wheat intolerant folks, Find Me GF app is free. Now, Matt French, who's one of our listeners, reached out to me on socials, Ben, and said, have you tried this one, which is called Atly, A-T-L-Y. This is not cash for comment, but this one's paid. It's not free, so you've got to pay a subscription. So I haven't actually tried it, but I had a look around, and there's some chefs and everyone gets involved in that. So obviously, if you pay for it, you might be able to get superior information that helps with that restaurants. But at the end of the day, it was an incredible life hack for me, and for some people who also have food allergies. Not like you, Ben, you bloody pie supporter. You can eat whatever you like. For us glutards, that was super helpful. Hey, Ben, what's making property news?
Well, Bryce, there's lots going on in the property space. We've definitely seen increased activity in the market. There's a lot more auctions and a lot more open homes, and there's a lot more people looking to buy. So the early indications of the market are positive. Now, It usually does bounce anyway. It's about
Sugar hit.
how much this sustains. That's going to be the big question in terms of whether we get into a FOMO environment, and the depth of the buyer demand in the market still hasn't been tested yet, but early signs are good. Anyway, I was caught this story that was in the Fin Review recently about obviously the question mark with the interest rate rise that we had in Feb. Should landlords pass on those savings to their tenants? And I think it's just a bit of a timely reminder here in terms of just how much costs have gone up in running your small private rental accommodation business. So there was some data that was also shared as part of this particular article, and I just wanted to share that data. I think it's quite important data. So investor mortgage repayments have increased by $1,483 a month nationally since April of 2022. Okay, and so that's based on the rate cycle from that time. By comparison, asking rents have risen by $472 nationally, leaving landlords to find an extra $1,011 a month to plug the shortfall. So I was recently on Twitter and someone engaged me on this idea that basically landlords should be dropping their rents. And I sort of said, look, at the moment, we're currently subsidising. A lot of us are subsidising our tenants. Now, that obviously people take a bit of offence by that, and I would always say to you, I think it's really important to understand that if you don't have a lot of debt associated with your properties, and you've got a great tenant, a great client, look after that client. I know you will. I know you'll do the right thing. Like at the end of the day, having heaps and heaps of money isn't going to bring you happiness. So do the right thing by the good tenants that you have. But you are running a small business here, and if your costs have gone up, they have to be passed on. And not only just in the interest, but also in the compliance costs, in the insurance costs, in the minimum standards, in all of these extra costs the government are laying on us, higher land taxes. These are costs in running our businesses. So unfortunately, as we've been warning to government, it will mean that rents will continue to keep going higher and our clients will have to pay that difference. So that was the national comparison. So I thought, well, okay, let's have a look at around the grounds. Sydney rental income has climbed by a total of $678 a month during the same period, and interests have jumped by $2,007, leaving the landlord $1,429 out of pocket. So that again is the extremity on the other end. And if we go to Melbourne, well, in Melbourne, that's blown out in terms of $607 is the gap. In terms of the shortfall in Brisbane, it's $1,397. And then when we look at the Perth investor, that's also surged by $2,114 over that time period as well. So it really does show, and Adelaide just around that out, $1,293. So now we realise that rates at the time were at very, very low levels. So I don't think that gap analysis is necessarily fair. But when we talk about long-term interest rates being around 5% to 6%, there's no doubt there that if rates go down to that sort of level for us, that we can take the pressure off in terms of passing some of those costs onto our tenants. But right now, as the current market sits, we are definitely doing that. So I just thought it's worth sharing that. Good luck to those clients of landlords who happen to be debt-free and have held the property for a long period of time. They may be more considerate, but those people who are new to property investing and running their small businesses, unfortunately, their debt levels will be pretty high. And so in their cases, passing on some of those in higher rents may be considered. Now, remember, still market forces. So if supply keeps driving higher, guess what? Even if the landlord wants to pass on that cost, they may not be able to. But that's ultimately where we sit right now in terms of the supply and demand imbalance in the rental market as well.
It's staggering just how much the poor old residential property investor has to withstand, right? Because you've got governments who come out and support that. That's largely because they need to be seen to be supporting certain parts of the electorate. You've got people who are part of the electorate who are advocating purely for the renters, and they're either ignorant or just totally oblivious to the fact that someone who is paying out of their pocket continually and then gets a slight bit of relief, so they're paying less out of their pocket continually, just the sheer thought of the fact that, let's just flow that on.
They don't care, Bryce. They don't care.
I get it's a political game, but it's just staggering because the irony is that the commercial property investors are the ones that are positive cash flow. So any reduction in rate is actually a genuine increase in the profit to them. Whereas for the poor old residential property investor, the reduction in rate is just a reduction in the paper loss that over time they want to get to a point where that's actually serving them positively. So it's just irony central here. But
there we go. But that just goes to show you that, like at the end of the day, we want to be mindful of there's people out there doing it hard, but there's also people who are doing this to build financial security for their family and loved ones. And they're buying a couple of properties. They're not property hoarders, as some of these people in social envy land talk about. So it really is about getting the balance right, but just letting everyone know that's just setting the context in terms of where that is. And if costs keep going up in any business that anyone runs, some of those costs are going to be passed on to their clients.
There you go, folks. The top 5 property questions on the internet. Ben and I have hopefully covered that there today. We will continue to look for what are the questions that people ask the most on the internet, and we'll have another episode coming up in the next 6 to 8, 10 weeks, Ben, as well. But, mate, it's always fun riffing with you. It's always good going back to basics as well, I reckon, because
we're back to basics today.
Easy to assume that everyone knows this sort of stuff all the time, but it's nice to remind folks of these are the most common questions people are asking. So it's worth getting them covered. Hey, mate, until next week.
Knowledge is empowering, Bryce, but only if you act on it.
Act on it, folks. See you next week.